Hello, everyone, and welcome to another episode of the Financial Advisors Want to Know podcast. I'm Catherine Tindall. I'm one of the CPAs here at Dominion. We're a firm that specializes in working for financial advisors on their tax and accounting needs. But today's episode, I have with me Kelley Long. Kelley is a financial wellness coach. She's a writer for the Journal of Accountancy, which, if you're not an accountant, maybe doesn't have as much street cred as an accountant that has a lot of street cred. And she's a narrator on the Calm app and a podcast host with a particular passion for HSAs. So that's going to be a big part of our conversation today, and financial wellness in the workplace. Thanks for joining me today, Kelley.
So happy to be here. And just to clarify, I'm the personal finance writer for the JOA, Journal of Accountancy. So my topics are very much would apply to financial advisors.
Yeah, that's great. So I'll post your page from them below too for people. I love the Journal of Accountancy, like just such.
I love writing for them.
Yeah, maybe one of my goals one of these days will be getting an article up on there. But because I think I was featured there for something a couple of years ago, but not a technical topic, and I'd love to do a technical topic article. But anyway, so today I want to talk about HSAs a bit. It's something that, in my encounters with financial advisors, it's not a topic that I feel is as well known as it should be. In a lot of the conversations that I have with advisors, it's not a plan. It's a planning tool that almost kind of like falls in the cracks for a lot of people. Because like the CPAs don't really own it. A lot of the financial advisors don't really feel like they own it. So for advisors who aren't very familiar, can you just give like a brief background of how they should be thinking about what an HSA, what is an HSA, what they should be thinking about in terms of using it as a planning tool, and then maybe we can get into some more technical weeds around applications for HSAs.
Very much so. Thank you. I speak on this all the time at conferences and in front of employee groups because you're right. Nobody owns the HSA. And a lot of people tend to think of it as an employee benefit thing because it usually starts with having an HSA eligible plan. But a health savings account is actually more like a 401k in terms of the individual owns the account. And one of the things I want to get into right away is the fact that the health savings account is actually a portable asset for an employee or just any client. And a lot of financial advisors are surprised to learn that, which is a great opportunity potentially if they have the technical ability to or compliance ability to actually manage HSA assets for their clients.
Yeah.
Because I could still be contributing to my HSA and still roll my assets over to another account and have them managed, or at least have them at a lower fee or have an opportunity with more investment options. And so probably one of the things I wish more advisors knew is that HSAs are portable at any time. You don't have to leave the job. You don't even have to leave the plan. And to get really technical right away, I guess kind of technical, is the way that HSAs can be rolled over is the same as an IRA, meaning that there's a direct trustee to trustee transfer option, which is unlimited. You can do that every month, but except with HSAs, the HSA providers tend to charge like a $25 to $35 fee per transfer. And so there's also the indirect rollover option, which a lot of advisors know as a planning point for IRAs. If you can withdraw the funds, put it into your checking account, and as long as it goes back into another HSA within 60 days, it's considered a rollover. And just like IRAs, that ability to do so is limited to once per calendar year. So when I was contributing to an HSA through a workplace plan prior to going out on my own, we had terrible investment options. They wanted to charge $5 a month just to invest the money. There was no interest on the cash side of the account. And so, of course, I wanted to move my money to a provider that offered better funds and lower fees. So what I did was literally on my birthday, because I would always remember that date and I would never do it sooner or after, I would write a check to myself out of my HSA for the full balance. And then when it came in the mail, I would immediately send it to my other HSA provider. And that was a way to avoid that fee and still get those other options at least once a year, whilst continuing to enjoy the benefits of payroll deductions into my HSA, which is another technical point. There's two different ways you can put money in your HSA. If you're giving to your HSA through a payroll, like through an employee benefits program. One is through payroll, but then if you get to the end of the tax year and you realize, oh, I didn't max out my contributions, I think most advisors know, and I hope tax people know that you can make an additional contribution before April 15th or whatever the filing date is in April and still deduct it for the prior year, which is super important for HSA holders to realize. But when you do that direct deposit, you don't get the deduction prior to FICA taxes. So for employees, that can save an additional 7.65% in taxes on their contributions. Now, self-employed people like myself, it's just a federal tax deduction. So it doesn't really matter. I don't have payroll.
Yeah.
That is why I always kept 2 HSAs. I kept the one my employer provided. Plus, my employer was putting money in my account and they would only put it into the account they opened for me, but I could have more than one. And so just once a year, I'd make that transfer. And then when I left that job, I closed out the old HSA, but I was in control of that. My employer didn't do that. It's not like the flexible spending account where people get confused. Oh, you got to use it or lose it. If I don't use it, my employer gets that money back. Calendar year limits. That's not the HSA. The S in HSA stands for savings, not spending.
Yeah, no, and that's a big difference. Like I've seen people make that confusion between those two accounts too. And as an employer, when you're thinking about, okay, can we offer some benefits like this? I always push people, like, if you can do the HSA, like, letting them have it where they're not going to lose the asset if they don't spend it, and having it be a way to really accumulate savings, makes a huge difference. So for financial advisors who are interested in trying to get this as part of their practice, and then especially if they can get it to the point where they can control what's going on with the investments in some of these HSA accounts, and really deploying it as an active strategy for people. Because, it's funny when people, the debates around, do you put everything in an IRA to try to get the tax deferral? But it's like, but what are rates going to be in the future? And you've got people that are in both camps. It's like with the HSAs, it's like, we all know the health costs are going to go up. Like, there's no question about that. Like, that's not tied to, especially as people age, right? So I think for advisors who are interested in, okay, if I'm trying to really build a holistic practice for clients, and I'm going to take them through their earning years and take them through their retirement years, and just health planning is just such a huge component in America for this. How would you recommend they think about starting from nothing, actually implementing this into their practice of trying to, relative pros and cons of doing this? Should everybody do this? And then in like, what are some of the platforms you recommend for actually implementing this?
Honestly, I'm not as familiar with the technical aspects of platforming, because I do know that HSAs have a lot of legal sticky parts, similar to like a lot of custodial firms won't enable SEP IRA management for advisors, just because there's different technical responsibilities of the custodian. So it's really going to be a matter of who your custodian is, if they allow HSAs as an account type. And if not, then finding, a way in your practice to either bill for adding that type of investment management. But really, particularly during the contributory years, the advice could be more just around making the most of the account by understanding that you can reimburse yourself at any time with funds from your HSA for expenses that were incurred as long as the HSA existed. And so people will feel like, well, what if I need this money that I'm going to spend on my savings to pay for a big medical bill? Like, if you have the money in savings, use it to pay your medical bill. You can always go back and say, you know what, never mind, I want that out of my HSA. But in the meantime, it's growing tax-free over here. And I think of my HSA as the alternative to long-term care insurance, because I'm on track to have over $400,000 in my HSA by the time I'm 65.
Good for you, Kelley. That's a good balance.
Well, and I didn't even start saving in the best practices in my HSA until I was in my late 30s. And so this isn't like a 25-year-old's going to have probably way more than they would ever need in their HSA if they engage in this through their whole career. But even a 50-year-old can start an HSA and accumulate enough funds in there to at least pay for their out-of-pocket healthcare expenses in retirement. But Fidelity estimates that the cost of healthcare for someone my age is going to be in the $250,000 to $300,000 range. So I still have like $100,000 that I could just pull out and, buy a boat or something, which people hate it when I use that example. Like, don't tell my clients to buy boats with their healthcare money. But I won't have to worry about that whole, like, should I buy long-term care insurance? What happens when the premiums get really high in my 80s and we're most likely to cancel it just when we need it? So it is
Mhm.
like bigger picture. It can be a huge comfort for the biggest wild card in retirement spending of like, what's my healthcare going to be? But also for younger clients, it's a hedge against like being stuck in a job for healthcare because you can
Yeah.
use your HSA to pay COBRA premiums.
Mhm.
And you can use your HSA to pay Medicare premiums. So it's a tax-free pot of money. So for advisors who engage in tax-efficient retirement withdrawals with their employees, the HSA is a huge part of that. Because if you've got somebody that, they've got their Social Security, if they're old enough, they have a pension, but let's just say they just have Social Security and we're trying to keep their other income below the limits to keep Social Security minimally taxed. You can pull money from the Roth, of course, get some
Mhm.
tax-free income there, but the HSA is actually a better place to pull that from, even if you're just reimbursing prior year expenses, just because the Roth you can pass along in a much more tax-efficient way from a wealth transfer perspective. The HSA
Yeah.
is not a great way to pass along wealth.
Yeah,
So when you
can you
die,
speak to that a
yeah,
little bit? Yeah.
when you die, your HSA is a trust, just like an IRA. So if there's a beneficiary named, they automatically get your HSA. If that beneficiary is your spouse, they get to continue the tax-free benefits. There aren't distribution rules around an HSA for a spouse. It just becomes their asset. But
Mhm.
anyone else, your girlfriend, your children, your grandchildren, your favorite charity automatically gets that account paid out to them, and they will get a 1099 to include that as other income on their tax return. So it's immediately taxable to a non-spouse beneficiary. Now, that person could use the money that they receive from your HSA to pay any outstanding medical bills from your end of life care and
Mhm.
deduct that from the taxability, but that they don't get the money then, they have to give it to the provider. There's some gray area on whether or not they could also use it to reimburse prior expenses that you hadn't paid yourself back during your lifetime.
Mhm.
So, like, let's say I die, I've got a spreadsheet that shows I had $70,000 worth of unreimbursed prior expenses that I could have pulled from my HSA, but I didn't. And I didn't do deathbed disbursement, so I just die with the 70,000 of unpaid money to my estate essentially.
Mhm.
The HSA rules do not state what happens if I, as the beneficiary of the HSA, turn around and like pay, say, let's say you inherited my HSA. If you turn
Mhm.
around and said, I'm going to pay Kelley's estate $70,000 back for what the HSA owed it, I don't see that could be a valid way to get you out of paying like taxes on that 70,000. Obviously, you'd have to give it back to the estate. It might make more sense if you are then the beneficiary of the rest of the estate, but it could cause other estate issues. And
Mhm.
but that's one way I could see like it reducing that taxability to the beneficiary. But eh, the best practice that I always hear, kind of like the check the box, is like, oh, just use your HSA for any charitable bequests and then take those out of your will or your trust and let your heirs inherit the rest of your estate. And
Mhm.
because charities obviously don't pay taxes.
Yeah, yeah. No, that's a good workaround for it. And I think it's one of those things where if you're working with clients who have a big accumulated balance in an HSA and you think that, doing in the estate planning, like that is part of just making sure that you have a plan for what's going to happen with it. And, especially too, if a beneficiary does get that 1099, it's like making sure that things are falling on the tax return the right way and that those get really
Yes,
messy really quickly, especially once 1099s are involved because they get reported over to the IRS and they're expecting to see it on the return.
exactly.
So that can get messy really quickly. So in terms of advisors trying to implement this into their practices,
Hmm.
I think that piece of advice was good of you got to see if your custodian will let you do things. But even if not, it's just a great way to holistically help your clients plan for their future in a way that's going to be more tax efficient by leveraging those. Um, do you have like other common things you see advisors screw up when it comes to talking about HSAs or planning around them, like common things that people mess up or things that people
Yes.
miss that they should be aware of?
I get an email a week at least from the general public, and it's often somebody's advisor trying to help them figure out they enrolled in Medicare and they continue to put money in their HSA.
Mhm.
And what do we do? And the first question there, and of course, the first thing they do is they go to the tax preparer, the CPA, and the CPA often is like, I don't know, call the HSA people. And the HSA people go, I don't know, ask your tax person. And so they call me or they email me because I've written an article about this, a Medicare and HSAs. And the problem that arises is, first of all, I think most people know that once you have other coverage, including Medicare, you're no longer eligible to contribute to an HSA. So you can still spend the funds, but you can't put more money in. And if you enroll right at 65, then it's pretty straightforward. So let's say you turn 65 in July and you enroll in Medicare as of your 65th birthday, you're considered enrolled on July 1st. You have 6 months of eligibility. So basically, whatever the HSA contribution limit is for the year, you get 50%. Now, if you've already maxed out your HSA for the year, then you have until your tax filing date to remove any excess funds. And basically, if those funds were contributed through payroll, you do need to pick them up as other income on your tax return, but you won't be penalized. It basically just kind of reversing those contributions. But if you are like me and you're making those contributions and it's not through payroll, it's just direct deposit, you just don't claim the deposit on your tax return and it's all good. But what happens when you've deferred enrollment in Medicare because you're still working and you have qualifying healthcare insurance? Most people don't realize that when you apply for Medicare or Social Security upon retirement, you're automatically enrolled in Part A 6 months retroactively. And Part A is that premium-free hospital coverage. And it's so confusing for people, first of all, because they're like, why would they do this? Like, why did they try to mess this up? And so I like to kind of give my theory on why this practice even exists. And I think it's because, let's think about why somebody might unexpectedly be enrolling in Medicare after age 65. It's because they got hurt or they got sick and they're in the hospital. And they lose coverage because they had to unexpectedly retire from their job. So basically having that 6-month retroactive hospital coverage kind of helps allay any concerns about medical bills that might be crippling to you with this unexpected issue. So it's actually a good thing that exists, but it messes with the HSA rules, when I'm sure the people that wrote the HSA rules did not think about this, because we know that a lot of our tax laws are like, obviously, whoever wrote this didn't know, right?
Yeah, the left hand doesn't know what the right hand's doing. A lot of that in the tax code.
And so that can really confuse people. So, and then there's this whole one-time IRA to HSA rollover, also known as a qualifying HSA funding distribution, where you once in your lifetime can take money from your IRA and put it directly into your HSA and not have it be taxed. And people approaching Medicare learn about this and they go do it because they're like, yes, I can at least get, $4,150 out of my IRA, my pre-tax IRA, tax-free into my HSA, then it's tax-free forever, which is awesome, except that there's a testing period when you do that qualified HSA funding distribution. You have to remain eligible for an HSA for 12 months after the date of the distribution. And so this is when the advisors end up in my inbox because they're like, I have a client who did this. I just figured it out. And I'll give a real example that is still in my inbox right now, going back and forth with the person. Made their qualified HSA funding distribution in April of 2024. They did the full year's contribution. So basically you can just do up to the amount that you're eligible to do for the year, including any other contributions. So this would be a year you're making 0 contributions otherwise. But this person turned 65 in February of 2025. And they're like, well, if I just delay my enrollment till the end of the initial enrollment period, what if I wait till May to apply for Medicare? Cool. Like your Part B will start on May 1st, but Part A still goes back to your 65th birthday or February 1st. So basically you will not be eligible for the full 12 months. You're failing the testing period. And there's really nothing you can do. This particular person had a non-qualifying healthcare plan. They've been purchasing their plan through the Affordable Care Act marketplace. And that is not qualifying coverage. So they can't defer enrollment without risking those lifetime penalties. So, but the thing is, in this situation, this is a 64-year-old person. Like they don't have early withdrawal penalties from the IRA. So basically they're just treating their IRA distribution as a regular distribution and taking the tax deduction for their HSA contribution and just taking out those 2 months of ineligibility. So it's not as panic inducing. And that rule, the qualifying IRA HSA funding distribution is more relevant for folks who are under the age of 59 and a half. And the whole reason for the rule is somebody who might have to otherwise take a penalized early withdrawal to pay a large medical bill because they can't afford to fund their HSA. But for folks who have plenty of funds and who want to like maximize their tax savings, I've already done my once in a lifetime qualified funding distribution just to see what it was like. My husband's going to do his
just to live a little bit, Kelley.
I was writing an article about it. I'm like, I got to know all the technicalities.
I got to do it. Yeah.
Yeah. I got to walk my talks. But so it's not as awesome as people might think it is, but it just gets into that whole, like, then this conversation with this gentleman was like, okay, well, what is my eligibility for how much can I put into my HSA this year? And it gets especially fishy when it's like, oh, I'm retiring on my 61st birth or my 67th birthday on August 1st, and I'm going to apply for Medicare in June. So your application date is when that clock starts back 6 months. So if you apply in June, you consider your Part A is 6 months prior to June 1st. You actually are going into the prior tax year for a month and impacting your HSA contribution. So where this comes up for advisors usually is when they learn that a client is getting ready to apply for Medicare, or maybe they already have, and they've been contributing to the HSA, and just helping them figure out, do they need to make a corrective withdrawal, how to put that on their tax return. A lot of times the CPA or the tax person, if it's not a CPA, doesn't know what to do.
Yeah.
There's a lot of panic. But that form, I don't know if you've ever had to fill out the form for, it's the 5329, and not to get too technical for my financial advisors on the tax side, but basically you are assessed a 6% excise tax on the overage, but it's the lower of the account balance or the amount in excess. So if I've got $3,000 in my account, but I only made a $1,000 excess contribution, I only have to pay the excise tax on $1,000. On the flip side, let's say I fully funded my HSA, wasn't eligible to fund it at all, but I've already spent the money. I don't have to pay the excise tax. The excise tax is to discourage people from making what people like to call a non-deductible HSA contribution. Yeah. There's no such thing. You can't make a non-deductible HSA contribution. So like the panic there is often just people not understanding how it works. And so I like to help financial advisors kind of walk through, like, this is how you calculate the numbers, and it's really not as horrifying, and the IRS isn't going to be knocking down your door and sending you levies for $10,000.
Yeah, unlike other places in the tax code.
Yes. Yeah, right. Now make sure you're sending your 1099s to your people that you pay cash, but
or just like I had someone the other day had a botched Roth conversion, but yeah, that wasn't fun. But so I think a big piece probably for advisors to take away, at least in my mind, is if you're helping clients through this process where they're getting close to the Medicare years and you're helping them with this post-retirement transition, you really, there is an HSA component. You at least have to have something within your process that you're addressing this, and making sure that even if you don't understand all the nuance of what Kelley's talking about, that you have something in your processes and in your systems to realize, oh, I need to talk to the client about this. Oh, there could be a problem here. And at least having that red flag go up so that you can then go noodle around on the Journal of Accountancy and then send her an email.
It's pretty easy to figure out once you realize there's a problem. It's just a matter of, if you could say to your client, hey, by the way, just make sure you are checking your HSA contributions so that you're not over contributing, or if you are, we get the money out of there in time. That's such a value add. Yeah. And that's really, can differentiate versus just somebody who's like, yeah, max out your HSA. Oh, talk to your tax person when you have questions about it.
Yeah, absolutely. And I think it's a point too. Like I was just talking to somebody on a previous episode about health planning and, operationalizing certain pieces. And one thing that they said that was just phenomenal, and I think is a good application point here is, have within your CRM certain milestone birthday pieces. And when, we're 1 year out from 65, that's probably when you should be having some of these conversations. Like, we're getting ready to go into, there's going to be a pretty significant changeover in a bunch of things in your life. Yeah. Let's make sure that we at least address this, or there's something in here that we're addressing this prior to like that 6 month, retroactive piece that can screw things up, and that we at least have addressed it so that the client understands, and that also that we're on the front of it so that it doesn't turn into a, he said, she said, getting in a fight, getting in a fight
Yes.
with the tax professional and looking, foolish or giving bad advice. Just knowing that you've got, something prior to that in place.
Exactly.
That's really helpful. So, Kelley, for people who are interested in learning more about what you do, and if they have these burning HSA questions, what are the best places for people to get in touch with you?
I mean, my website is financialblisscoach.com. That's the best way to learn about how I work with people. I mostly use LinkedIn and Instagram as my social media. LinkedIn, I'm Kelley C. Long. Instagram is Financial Bliss Coach as well. You can send me a DM that way and I'll send you my email address. But I would just say that the Medicare website is a great resource for folks. Like it actually has a lot of really helpful, user-friendly tools to help figure these questions out as well if you want to do some research yourself for your clients.
Yeah, that's awesome. So for people listening, we'll post the links nearby of how to get in touch with Kelley and the various things. We didn't even get to talk about how you're on Calm.
I
Which
know.
it's like after listening to all this about HSA, it's like, okay, well, let's go into calm mode. You don't need
Yes,
to be freaked out about all this. It's just a matter of knowing what
totally.
the rules are. But
It's
yeah, I want
called
to thank.
Navigating Financial Stress is a series that I
I
have
love
on
it.
Calm.
It's something everybody needs.
Yes.
Well, I want to thank you again, Kelley, for coming on. Any closing thoughts that you have for advisors listening of, maybe something that we didn't touch on during the show that you think they should hear?
I would just say that HSAs are not as scary as they might seem, especially if you can catch any errors within the tax year or by the tax filing deadline. And you're not giving tax advice by helping
Mhm.
someone calculate their contribution amount. But if it's fuzzy, that is something that most CPAs should be able to figure out.
Yeah, awesome. So, listeners, I just want to thank you again for joining us for another episode of the Financial Advisors Want to Know podcast. And we look forward to having you join us again on another show. Thanks so much, Kelley.
Thanks for having me.